Okay, in this video we're going to work practice exercise 8-5B. It's from page 386 in your book, and we also worked it in class. In this example, we are going to perform the journal entries for a note receivable. So this example has a note receivable being given in exchange for an account receivable. Right, so in this scenario, somebody can't pay their account receivable, and so you say, well, okay, we'll replace it with a note and you can pay us some interest. Right, so the thing about these notes receivable is you have to be able to calculate the interest, and that's something I will expect you to do on the exam, is say, oh, that's a note receivable, there's some interest, and be able to calculate for the number of days the correct interest amount. So in this example, there's a 120-day note at 8% for $450,000. So there's your face amount, or the principal balance, as we call it. 8%, there's your annual interest rate, and there's your number of days. All right, and it's Prefix Supply Company received a note. Okay, so we're just going to go ahead and do the transactions it asks for. Determine the due date. All right, so in this example, I'm not going to ask you to ever do this, but 120 days from April 9th would be August 7th. All right, 8-7. And all I did was add up the 21 days left in April, right? 31 days in May, 30 days in June, 31 days in July, and then how many more days do I need to get to 120? I needed 7 out of August, so that's 8-7 is the actual due date. But on exams, and I'm going to just tell you, this is a 90-day note, a 30-day note, whatever it is. All right, so you won't actually calculate due dates. Next, determine the maturity value of the note. So the maturity value of the note is the principal, or face amount, as they call it in the book, plus 120 days worth of interest at 8%. So let's just calculate that interest. Okay, so you may recall from class that interest is always principal times the rate times the time. And in this case, our principal is $450. 450,000. That's a big difference. 450,000. And our rate is 8%. And I'm just writing it as 0.08 because that's an easier for me. That's how you'd put it in a calculator, 0.08. And then times 120 days is the time. But this is an annual rate, right? Remember that from class. That's an annual rate. So we either have to turn that into a daily rate, or we have to turn our time into a portion of a year. So it's easy to turn it into a portion of a year. I just write 120 divided by 360, and so you remember that to make calculations easier in this class, we use this 360-day year convention. So the 120 days divided by 360 gives us what part of a year that is. It's third, right? So we just multiply that, and we're going to come up with an interest amount of $12,000. Right? So that is the interest amount. So the maturity value of the loan then becomes the principal, 450 plus 12,000 equals 462,000. So that's the answer to B. The maturity value is principal plus interest. And you'll have to be able to calculate that. I'll expect you to know how to calculate interest on a note receivable. The next thing we need to do, journalize the entry to record the receipt of the payment of the note at maturity. So on August 7th, the people who owe the note come in with the cash, and they give the cash. And certainly we've calculated the amount. They're going to come in with $462,000 and pay off that note. 450 of it goes to the note receivable, which is an asset, and 12,000 of it goes to interest revenue, which of course is a revenue. All right, so we got cash. So to analyze the transaction, we got cash coming in, so cash is an asset, increases with a debit. Note receivable is an asset, but we're decreasing it, right? We're paying it off. So that's going to be a credit. And revenue, when you increase revenue, that's always a credit. Remember how back at the beginning of the semester we talked about revenues on the right? So that should be pretty easy to journalize. Cash, note receivable, and interest revenue. Date, account, debit, and credit. And the date, of course, is August 7th. And the account that's easiest to keep track of is cash, and that's cash coming in. And we decided it was 462. All right. And the credits are going to be this asset that's decreasing. So the note receivable, right, was 450. That's what it's on the books for, 450. That goes away. And then our interest revenue was 12,000. And this is equal to these two added together, so our debits equal our credits. And we're all done with that problem. So that's practice exercise 8-5B, notes receivable. I'll expect you to be able to do this kind of thing. Determine how much cash, determine the note, the interest that they're going to receive. So don't forget this interest calculation. Principal times rate times time. And remember, on these notes receivable, when you see an interest rate like 8% or 10%, those are annual. But these notes tend to be in terms of days, 90 days, 60 days, 30 days. So you have to turn that into a portion of a year by doing this. All right, that's it. The next thing we'll be working on will be exercise 8.13. That's on a separate video.